Welcome to China Gateway 360, connecting global businesses with China through insights, opportunities, and trends. Today, we're looking at how China's industrial profits just surged 18.7% in the first half of 2026. Now, at first glance, that 18.7% figure is pretty impressive. It's actually the strongest first half growth we've seen since 2021, according to the July 27th data from the National Bureau of Statistics. But here's the catch. That flashy headline number is actually masking a deeply uneven sector-by-sector recovery. When you break it down, the disparity is stark. Right at the top, there's a massive 34.2% jump in electronics, which is being heavily fueled by government-directed investments into AI and semiconductor infrastructure. Automotive is also running hot, but then, as you look at other areas, things start to cool off. Consumer goods are sitting at a much more moderate 6.1%. And then, at the other end of the spectrum, there's the persistent drag of the property and construction sector, which actually contracted by 8.5%. So, what does this all mean? Well, we really need to shift our focus to the underlying risks here. Because despite those strong top-line profit numbers, the NBS data is quietly revealing mounting liquidity stress happening all across corporate China. The numbers paint a very clear picture. Accounts receivable have stretched out to nearly 60 days. Meanwhile, the inventory-to-sales ratio has climbed past 52%, and debt-to-asset ratios are creeping up to 57.8%. If you're a foreign business operating in this market or sourcing from it, this is your warning sign. You absolutely need to expect slower payment cycles and significantly tighter credit conditions from your Chinese manufacturing partners.
China Gateway. Gateway.
Your gateway to business in China.
Knowing all of this, how exactly should you be adjusting your 2027 budgets and operations? Let's run through it. If you're in the tech supply chain, you're going to want to accelerate your localization to capture that surging demand. For consumer brands, definitely model more conservative volumes moving forward. If you're supplying the property sector, budget for continued market contraction. And honestly, across the board, no matter your sector, now is the time to tighten up those payment terms to mitigate your credit risk. Ultimately, this data reveals exactly who is in the driver's seat right now. While state-owned enterprises accounted for 38% of the profits, they only saw 24% of the revenue growth. It's really the private sector tech companies that are doing the heavy lifting and driving this margin expansion. That's all for this China Gateway 360. Like and comment to receive materials from us. Thanks for watching, and we'll see you next time.